And welcome out. That sound means that we are live here on our webinar, our daily halftime report from tackletrading.com, a stock market show where we talk about charts and news and in commodities as well as economics, anything in the market that's grabbing our attention, break down some ideas and try to have some fun while we're doing it. On today's show, we've got some economic data that came out, jobless claims for the week again, that did come out, and we'll talk a little bit about that. Natural gas is selling again, and maybe seasonal considerations. We're going to get an update from our commodities guy there, Mark Justice, Coach Mark on the back end. We're going to talk a little bit about some of these companies that are moving and showing us some action. And really the news of the day will be later today with the bank stress test when that come out tonight. We'll kind of set up what we're seeing in the market and changes in this market condition. If you are a veteran of our show, welcome out. As always, hashtag Team Tackle in the chat. Click the thumbs up. Make sure that you represent. And if you're brand new, you're coming to join us for the first time, click subscribe, click the bell, come back and join us every day. We do this every day. The markets are open and live. We've got Mark, we've got Noah, we've got Matt, and we've got Cody, full panel here today. Let's roll here, guys. Maddie, I know you're sharing screens. Why don't we start with the charts on the market? Mark, I'm going to start with you, actually, if we can, and kind of just let's talk a little bit about the markets in general, because there's not a lot of news today that is really noteworthy. The jobs data is interesting, but jobs really aren't moving the needle. We've got a doji here today sitting on support. We broke down the charts a little bit ago. No, I'm going to have you do technical analysis. But Mark, does it feel like this market is somewhat changing a little bit here the last few weeks? What's your read on the broad market?
Dude, when a crazy person's running down the street and just because they run across the street 3 times instead of 2, I'm not going to try to analyze. This market has been crazy for 5 months. It has been patterns emerge and quickly go away and buy up some news, sell some news. We haven't seen one definitive pattern that I could say that I trust for or whatever. It still seems to be very news driven. And like the jobless claims this morning were 1.48, a little higher than expected on the bearish side, right? Still have, and put that in context. In the entire 2008, 2009 Great Recession, the biggest number we ever had on the jobless claims number was about 680, 90,000, somewhere in that range. Here we are 16 weeks into COVID, and we got a 1.5 million number. I mean, let me think about that and process that about how, still 4 months into COVID, when society's supposedly reopening, we are still laying off people at the twice any historical number ever. Now, on the bullish side, the continuing claims came down a little bit. So they were at 20.3 million. They fell to 19.5 million. So for the bullish side, well, people are still filing for unemployment at record levels.
I get that. I get that they're calling that bullish, but I find that to be absurd, quite frankly. I understand what you're saying.
I'm just trying to tell you what they're saying.
But the idea that 19.5 million people continuing to be unemployed is somehow bullish because last week it was 20 and we're down 60,000 or something like that is crazy. I read those stories all over the news here this morning, Mark, but I find that to be very silly.
That's fine, but the simple reality is they missed on the expectation, and the entire argument over the weeks about the economy reopening up, his initial claim specifically, has gotten better every single week until this week. And that goes in line with the data we've seen over the last 7-8 days, that this V-shaped economic recovery, it's not transpiring here. And quite frankly, it does feel like the market is behaving differently right now. And yes, it could be in the short term, but it does feel differently right now than it did even 7, 8, 9, 10 days ago. I think this is not as easy as it was when the reopening economic thing was happening and everything was going up. It's coming back into much more of a stock pictures market.
I agree wholeheartedly. The data though, Matt, last week was 1.54 million unemployment. This week, 1.48. So yeah, a little bit less, but these are still very elevated numbers, very concerning if you're thinking about long-term. And I get that the continuing claims did come down. but we're still talking about 20 million people not working.
And you're also talking, yeah, I mean, these are not the numbers on initial claims that we were seeing even as of, 3-4 weeks ago from an initial claims perspective. But even the numbers that we've seen in the last 2 weeks, guys, we're now, like Mark said, we're now like 16 weeks into the COVID. We're at least 6 weeks into the economic recovery, right? And so you're looking at the data here today, 1.48 million initial claims. In comparison, looking at that in a normal market environment, that number is still one of the all-time highest numbers we've ever seen in our entire economy. So but it's not just the data. I mean, obviously the unemployment claims today was not a good number, but it's not just that. It's the fact that the market's not playing offense at all anymore outside of certain specialty areas. The market is just playing defense, and just playing defense is not a reason to get aggressive.
Mm-hmm. Noah, and I'll come back to Mark on the news analysis here in a minute. Noah, in the price action here, we're seeing a doji today, and like Matt's talking about, those pivots are now getting a little bit funky. Moving averages are coming in here together. For the last 2 weeks, basically, we've been in this range since that sell-off 2 weeks ago on Thursday to the day here. How are you approaching the market, Noah? Are you staying directional? Are you looking for picks in tech? Are you looking for bears in other areas? Are you starting to play theta? How are you approaching the market right now?
Well, I've been building up my theta for the last couple of weeks, as far as that goes. But I do like the general location of this doji. When it comes to candle patterns like dojis, location is the most important aspect of it. The fact that it's sitting on that big fat 200 period moving average, that's about as strong as a signal as you can get if you had a nice, bullish trend prior to that. With the sideways action the last couple of weeks, where it's just kind of been hovering back and forth between that, call it 3,000 and 3,100, 3,200 ballpark. I'm expecting a bit of a rally, but I don't know if it's going to break out. It's going to have to clear that 3,150 resistance zone to really give me any confidence on a directional run. And if it breaks down, I think the 20 is that a rising 50 period 50. Average? Rising 50 will catch it because that'll coincide real nicely with the old support resistance zone that you can see on the left of the chart. So if we get a breakdown, I'm not expecting a huge panic sell-off. I expect the buy the dippers to step up just like they did 2 weeks ago.
Mm-hmm. Mm-hmm. Mark, with this unemployment data, obviously, I do want to get one last thought in on that and get you guys' thoughts, Matt. Mark,
I got a question, Mark, because I kind of hear both of them are a little bit more on the bullish side of it. So I want to hear their thoughts a little bit more.
Sure.
The technical pattern has obviously changed. The market response to the news has obviously changed. The volatility has changed. The geopolitical situations has changed. The viruses weren't, the economy is not V-shaped recovery, but I'm still hearing buy the dip mentality here. What gives you that confidence?
It's not my confidence, Matt. It's their stupidity.
Explain.
Please expand on that, because I don't understand.
Do you think the buy the dippers have really picked up on the nuance and the changes, or are they just playing the program? Like, oh, every time it dips, you buy.
All I can do, I'm not calling them on the phone. I can only read it on the chart. And right now they're changing their momentum. So I would say yes, no.
Well, maybe. And so if it breaks down, I just haven't seen any real strong bearish sentiment sticking.
I can just tell you what I'm hearing from the day traders following Dave Portnoy on Twitter, who got his ass handed to him yesterday. There's a little bit of a lost flavor there. They got handed this distressed area. Remember, this area of the market, they're not buying index funds, guys. They're not buying strength into the market. They're not buying Apple and Microsoft and Google and Amazon. That next generation that has, been really that Robinhood generation, they're buying pandemic plays, but for the most part lately, they're buying distressed areas of the market that have not played out in the last week and a half. That distressed area play got blown up in the last week, guys.
Mm-hmm. Well, yeah, and I didn't particularly like the distressed areas myself, and so if I'm buying the dip on anything, it's on stuff that's leading sectors, techs, staples, those types. Or is it not staples?
Right, those
yeah.
The pandemic groupings and the tech groupings, the ones that have been leading the market. Noah, are those the ones you're still targeting?
Yeah, basically. Yeah. And again, I mean it is neutral, and I have been building theta, so I'm playing it as appropriately. But if we see a breakout, I don't underestimate the stupidity of people in large numbers, and so why not? If you get enough people to drive it up, they'll pile on.
I don't think you have to guess. I mean, can't you just wait for confirmation?
I'm not seeing that in the data though. Is what I'm not seeing. I mean, don't get me wrong. I'm not saying the buy the dip is over. The buy the dip has been strong for, oh Lord, as long as we've been alive, right? That's kind of what it feels like. And I am certainly still bullish here, but I'm just saying, I think it's appropriate behavior to get a little bit more cautious, given the fact that the euphoria we saw from mid-May to really kind of coming into the second week in June, that momentum has obviously stalled. And some of it is stalled not only just because the market hasn't went up, but some of the data that really supported that market euphoria. Because do we really think it was Davey Day Trader that drove this market up, guys? I mean, do we really think that?
No.
Do we think millions of kids who were getting $600 payments for unemployment was really driving a $25 trillion market cap? Really?
No, I don't. Which I guess begs the question: do we think it's going to matter next? I mean, do we care what they're doing?
No, they're in the news, but their money doesn't drive stock, guys. No. It just doesn't. So I don't believe it was Davey Day Traders and the emergency of the Generation Z day trader that was really driving the marketplace.
Is that Dave Portnoy's nickname? Davey Day Trader.
I like it. If it's not, it should be.
That's how we're gonna.
I'll go with it. I think it's your fund managers, Matt.
I think it was Davey. I think his nickname is Davey Day Trader. But I'm just saying the belief in the market at the Wall Street level in that V-shaped recovery was legit, and it was real, and they were having data to support that philosophy for like 3 to 4 weeks. And again, I'm not suggesting here, on a Thursday, June 26th, that the train is over, right? Support still has not been violated, and that's the number one thing here. But I do think it's a little bit, I honestly, quite frankly, foolish to think that things haven't changed when over the last 7-8 days of trading, you haven't seen anything in the marketplace. And the data has not been great out there. It hasn't supported the V-shaped economic recovery. And quite frankly, the market is starting to not buy negative news. So how many times did, in that run up from mid-May to mid-June, how many times did we see markets go up in the face of negative news?
Oh, constantly.
All the time.
They shrugged it off.
Time. Yeah. And now what's happening? In the face of negative news, it might not be selling aggressively, but it's not buying in the face of it. Mm-hmm. And isn't that a change in psychology in the marketplace?
In the short term, for sure. There's no doubt about it. And I think it comes down to, how do you approach it? I think you still have a stock picker's market. I think you're more willing to go negative delta with breakdowns. Like we were looking at a bunch of breakdowns yesterday, Matt. There's a lot of charts that are rolling over, but I still think you got to have bullish list ready because there's still a lot of strength in the market. I mean, you look at the tech names, not distressed, but the pandemic names.
I get the disclaimer you just put out there. I get it. People have to.
I got more bull charts.
No, I get the disclaimer. I'm saying I understand why you threw the disclaimer out there because, when you talk about things that could impact the market to the negative, the trolls online will come out and be like, oh, you're just a doomsdayer. No, you're analyzing data. You're having an open conversation. I do think as a society, we need to stop putting disclaimers out there just so people don't get offended at your opinion on something. When your opinion is 15 years and millions of trades, you should just speak your opinion in my humble opinion there. So I'm kind of getting sick of the public disclaimers everybody has to put out just to appease the masses. The reality is the data we're seeing has not supported the V-shaped recovery in the last 7 to 8 days. And the market response has been extremely lukewarm in that environment in the face of last month where the market was just buy everything in the face of whatever data came out there. That is the only thing I'm suggesting that is throwing a little bit of cold water on that bullish buy mentality, because like Davey Day Trader likes to say, stocks only go up. Well, he's starting to realize that's not true.
I love the nickname, by the way. is going to make me
he gave
giggle
it to
all day.
himself. So like,
I didn't know. I have no idea. I didn't know about that one, but I do. I do like the
where do you think DDGT comes from? David Day Trader.
David Day Trader. All right. I'll tell you, I mean, just from my own personal trading this week, I've done more theta trades this week than I have in 2 months.
Okay, then let's go on that then. Okay.
Yeah.
I'm hearing from Noah, buy the dip, bullish, setting up support. I'm hearing from Mark.
Well,
buy the
allow me to
dip.
go back and make.
Hold on. Let me finish my point.
I
then
never
I'll bring
once
in.
said buy the dip.
Hold on. I heard buy the
didn't say
calls
that.
earlier.
Oh, I said buy the dippers. I didn't say buy the dip.
But yet I'm both hearing from you, stack theta, which is not a buy the dip mentality.
Well, I don't have a buy the dip mentality. I said others might have the buy the dip mentality.
If it breaks out, I will play bullish, no question about it. But this week I've had more bearish trades and more theta trades than I have in several months personally. And I do think the market changes obviously creates opportunities for different strategies. When it was just ramping for 3 weeks in a row, I mean, during the month of May, the back end of May, and the first few weeks of June, it just went straight up every single day in the face of negative news, even if it was COVID news or geopolitical news or China. Market didn't care. Now the market starts to seem like it's caring a little bit. Doesn't mean I'm flat bearish, but I do think that you're right, Matt. There is definitely a change in this market over the last 2 weeks.
And it's just
price action.
Subtle.
Yep.
It's subtle. It's not a massive new wave of bearish sentiment that's going to drive the market down. And oh my goodness, the end of the world is happening. Okay, radicals, get the hell out of here with that stuff. It's subtle, right? Yeah. And all I'm suggesting is there's moments and times when we see these rotations, Tim. I called the rotation into the reopening theme a month ago. It was subtle. And it was just simply asking you guys the same question that I asked you guys to spark a conversation. Are you guys seeing a little bit of short-term shift in market sentimentality regarding those distressed areas of the market? If you remember, I brought up FinViz to show you 2 days of evidence of this rotation happening, and it sparked a conversation. The same thing here. It's subtle. We're seeing a subtle shift, but it's the people and the traders that are early in recognizing and identifying those subtle shifts in market behavior that become a trend in market behavior. It doesn't have to play out until we see more data, and nothing changes until we see, some type of intraday resistance or support level broken to form a trend. But I think because of that subtle shift in market sentimentality towards those distressed areas of the market, towards the buy and the buy the dippers have not been playing out in the last week and a half, I think it's appropriate to maybe shift to being a little bit more from the buy to maybe be a little bit more cautious right now until this market euphoria picks up again.
Mark, you said to me earlier that you thought maybe we're going to be moving into some consolidation on broad markets. Is that your assessment still?
Yeah, I mean, I think you have the market conditions. You have the sentiment conditions just from my, anecdotal reading of it. It's just to set up a consolidation range. I mean, once again, I mean, if you have a vaccine catalyst where it's an actual vaccine, if you have some external event that we don't know to the downside, that could break a consolidation pattern. But you got crappy economic data, you got an unrelenting Fed. As long as you get that trillion fiscal stimulus, it's hard to see it going lower than 2,800. If you get that another trillion. Now, if you don't get it, or if it's geared not towards individuals and small businesses, that might spook the market. But, based on existing information, it's just, 28 to 3,200. That seems like, I mean, that's a broad range. I mean, we're currently in a little one, right? A little 3,000. What is that? 3125-ish.
You're in a tight range there.
3150 by 3,000 is your range.
Yeah, so I mean, you're in a 15-point range right now. A 40-point range over the next 5 months wouldn't surprise me at all, as long as the Fed and as long as the government provides that fiscal stimulus. That's essential for the bulls, because the bulls don't have economy. The economy is crap, and it's going to remain crap. Unemployment is going to be like 8% next year. Consistent.
Mark it down right now, Tim. Mark it down right now. They put out $1 trillion stimulus. The market will not be bullish in that.
That would be shocking to me. I mean, because there's not the assumption they're going to pass it.
They just passed 2.3 trillion in Fed in fiscal stimulus, and they just passed 3 trillion in monetary stimulus, and the market literally didn't do a thing in the face of the Fed announcing corporate bond buying. $1 trillion is nothing to the economic damage that is happening around the world.
Oh no, I agree with that 100%.
My point is $1 trillion. If that is the final number, that's light in comparison to what the lost economic and GDP data from around the world is.
I think the big part of that stimulus will be the unemployment benefits, if they extend them or not. I mean, and that's coming up in July, because if that $1 trillion goes directly to individuals to extend unemployment all the way through the end of the year, that's a different $1 trillion than if it just goes into like bond.
That's fine. That's fine. But I don't need to talk about fairy tales and fairy dust and things that won't exist or happen. The government's not going to give people money. Even in the first stimulus, they gave a very small percentage of the money to people. That stimulus is going to infrastructure. It's going to corporations. That's where it's going.
Quick peek at the NASDAQ here, Matt. In the general conversation we're having, I think just that S&P, the Dow, the Russell, they all feel very much the same. I tweeted out a graph of the different sector performances for the month of June, and everything is down, but the NASDAQ and tech specifically is up. And we talked about these groupies in the podcast earlier in the week. That's a very different chart, though. So even during the consolidation of the broad markets, are you guys still looking for bullishness in tech? Noah, Matt, yes,
I do like the setup on tech. I mean, well, the big difference between tech and the S&P is that you had a lot more sideways chop and a much bigger loss of overall momentum. Tech still recently posting new highs. So even though it is slowed down, there is a slowdown there on that chart, make no mistake, but it's a pretty enough setup that I'd say there's going to be some decent looking pullbacks, and there's going to be I think some bullish pressure off of this. Again, we'll see.
Yeah. I mean, you only get the one red candle in there, Matty. That's obviously not a pullback. Do you just ride the trend here and look for individual stocks?
The obvious answer is yes in the NASDAQ. Even in the S&P, I'm talking broad-based market analysis, right? You're talking 500 stocks, 11 different sectors. When you break it down, the sector analysis in the S&P, you're going to see certain sectors set up for strength, and you're going to see certain sectors set up for weakness. And that's really the conversation that we're having right now. And it's just an extension of the conversation we've been having for 3-4 months now. What are those themes that are playing out in the marketplace? And, I'm suggesting overall in the broad market, that theme of buy everything, when you were seeing, really not selling in the pandemic and the blue chip plays, you were just seeing consolidation, and you were seeing buy into this, and then you would rotate to buy into that. So things would consolidate, go up. The other areas of the market would consolidate, go up. We're starting to see a subtle shift in that behavior to where it's not just going to be as easy as throwing a dart at the Wall Street Journal from, May to June, for example. But the NASDAQ is extremely strong here. It's obviously the strongest area of the entire marketplace. Tech has been a safe haven. And I know that's weird to think about from a traditional market cycle perspective. But at what point do we have to admit that the traditional market cycle is not showing its teeth in the last 10 years, right? I mean, things have changed in the market cycle. Tech has been extremely strong, no doubt, but it's also seen psychologically as that safe haven in this pandemic, because we're not going through a normal recession where, we're seeing broad-based selling and so on and so forth. And, tech's overvalued and getting beat up like we saw in .com and so on and so forth. You're seeing tech in this pandemic play as this safety play, because even though we're all sitting at home, a lot of people are working from home, but we're all using more technology, right? And I still maintain what I said coming into the year. If you're going to bet on one sector every single year for the next 20 years, bet on tech. Most of the time, you're going to be right. Some years, it's going to be weak. Some years, it's going to stagnate. Some years, it's going to get so bubble-like condition, it has a crash. Yes. But overall, I think you'll be right 80% of the time if you bet on tech. And so tech right now, extremely strong. I do want to identify some of that slowing momentum that Noah talks about. Now, again, slowing momentum is not a indication of bearish momentum. It just means the market's slowing down just a little bit. And so when Noah talks about that, he's really looking at that euphoria that happened that we were talking about with the buy everything moment, where it really kind of took hold from mid-May to really kind of that second week, mid-June. So about that 1 month stretch right here. And you saw that momentum play out when the NASDAQ went from 88.70 all the way to that ping in right there at about 10,100. So, it moved up about 1,400 points. Now you kind of drive in from about 9,500 all the way to about, 10,300. So you're talking about 800 points. So That's the momentum Noah is talking about when he says that we are slowing down a little bit. But again, slowing down just means that you adjust your strategy more than anything. Instead of like buying out of the money calls in a market environment where, everything is just hog wild crazy to the top side, you might want to adjust it to be a little bit more cautious, a little bit more conservative with your strategy selection. Instead of buying, straight up 25 delta call options to take advantage of it, maybe you adjust to doing more of a spread type play, like a bull call spread or something along those lines. Maybe you wait for confirmation, wait for a little bit of price appreciation, and then you start selling calls against it to offset risk and bring in a little cash flow. So you're still bullish. You're still looking for bullish opportunities. You're still looking for, breakouts in the NASDAQ, no doubt about that. You're still looking at those blue chips from a trading perspective. You just might be a little bit more conservative on the strategy selection.
I agree 100%, which is why I've done a lot more theta this week, but I'm obviously still looking at some of those delta plays. I like the idea of the bull call spreads. Tackle Trading Playbook has a lot of different strategies in it. We'll take a look at that a little bit later. Apple Computer here, Matt, I think is a good one to transition to while we're talking NASDAQ tech stocks and everything in general, because the other conversation in the market outside of economic data and the market slowing down just from a price perspective is the COVID stuff. Apple closed down 7 stores in Houston, guys, because Texas is having rampant up outbreaks and whatnot. We saw, and we've talked about some of that data. The market seems to be caring a little bit more about it. Now you look at the chart, market didn't even react at all to Apple doing this, but I think closing stores, we saw something out of Disney today where they're delaying the reopening of Disneyland, where they were trying to get it in July. And they're like, well, I don't know if we're going to do that. We're going to push it out now. This is not going away in this regard. And it might not be big government shutdowns or sweeping, things like that. It might be companies, it might be states, it might be cities that continue to have to put in restrictions based on COVID-19 data. Mark, quick update on the daily, COVID stuff. What have you seen in the data today?
There's not a whole lot different that was from a big, huge, I don't know, hospitalizations up. Let's recap the week. Hospitalizations up in a few states, cases up in a lot of states. We haven't seen a huge spike in deaths, however. That's starting to hit the media a little bit today, something that's been underreported on the case front, basically saying, a lot of the people getting cases are younger. We know the mortality rates are skewed towards certain populations, older individuals, people with comorbidities. A lot of the new case numbers are younger, accounting for the spike. It doesn't mean that anyone young can't die. We've seen plenty of evidence of that. It's just they're really, really, really low, right? Your chances of surviving COVID if you're under the age of 30 are really, really, really high. So the death rate hasn't spiked. Other metrics have. A lot of people have a lot of different opinions on it. It's almost like when you talk COVID now, you're talking politics. I hate it now.
Yeah,
somehow COVID has been
sad,
politicized.
Mark. It's so sad.
I wish, like, seriously, because we run a business, and I would like to talk COVID from a market perspective, scientific level. But it's like if I give any opinion on anything, I piss somebody off because it's become politicized, and that's nonsensical. And y'all need to check yourself if that's what's happening with you internally.
Mark, let me say something really quick to that too, because I agree with you. If there's one situation we need to leave our political, viewpoint aside here, it's got to be a pandemic that is threatening people's lives. This is a human issue. This is not a political issue. And it saddens me that in the United States, we have made this a political issue because, quite frankly, it is a political issue now. But at Tackle Trading, we're apolitical. We're going to talk about the virus. We're going to talk about the impact. We're going to give our opinion out there. And we hope to not offend anybody because we love everybody. We love our people on the right. We love our people on the left. I obviously have, political viewpoints that are on the right and some that are on the left. I think we should be more open with one another. We should have more conversations with one another. We need to stop getting offended. It's just simply because somebody has a different viewpoint from a different perspective. And I certainly understand the frustration. I've felt like I've held my tongue a little bit, Mark, in the face of that because I didn't want to offend certain people. but this is a human situation, and this is not a political situation. And people who are making it about politics are making a mistake. We need to approach this from that perspective. I understand the frustration because I've felt it too. I think a lot of people have, quite frankly, even talking about it over Sunday brunch with your family to a certain extent. But we have to talk about it, and hopefully people don't get offended because somebody has a different perspective on something.
And if you can't separate, and this applies to so many things, if you can't separate your personal opinion and your politics from your trading and investing, you're going to have a real hard time. Like, we all have opinions in that, but we have to analyze things from a charting perspective, from a fundamental perspective. And if you bring your bias in, I don't care if it's politics or whatever, it's like, if you bring your bias into sports betting and like the Cowboys are the greatest thing ever, and I'm just going to bet Cowboys, well, it's going to work out for you sometimes and it's not, but you're not going to become a great gambler.
I've seen that so many times.
I'll give you a perfect example of it. Every year when we play fantasy football, I try my best not to pick the Dolphins players, because every time I pick Dolphins players, I end up doing really bad in fantasy football. Have your likes, have your loves, have your passions. It has no role in the world of finance. None.
Well, even the politics doesn't either. You know how many times over my career, Matt, real quick, somebody gets elected president, right or left. The examples don't matter because I've seen them on both sides of it. And somebody in my life, a student or somebody in the markets, are like, oh, I'm getting out of stocks now because of that. And I'm just thinking, there's no correlation there. I mean, there's data, there's finance, there's the markets. People pull in their worldview and it affects their decision making. And that is a problem. That's a mistake. It's a mistake. When you trade.
It's also something very few can master, though.
I get it.
Hey, listen, as long as the president remains Jay Powell, the market is going to be
yeah.
No. You messed up on one thing, Mark. He's not the president. That's king and queen and country at this point, brother.
Yeah. That's right. That's funny. By the way, I guess maybe with this Apple, maybe the last question for you guys, the stories out of Disney and Apple today, they're anecdotal reminders that we're not done with this COVID lockdown in some regards, and all this assumption that everything's going to get back to business. Like even sports, guys, I know I don't want to be the bearer of bad news, but they're going to have problems with these sports things. I was thinking about this NBA reopening with Disney, Matt. What happens if they have COVID outbreaks? They got to stop the games. I mean,
they're not going to stop. It's going to be interesting because if the public pressure gets on them, I honestly, I think we need it. I do.
I want to see basketball.
Yeah. And maybe that's just my own personal, like talk about personal bias, right? I'm like, I really want to see Tua this year. Just give me a Tua sighting. I've been waiting for 5 years for Tua, 4 years for Tua. Don't stop that this year, virus. No, it's going to be interesting. It's taken from a corporate perspective. What Apple do today? They shut down more stores, right? But the NFL can't shut down 2 games. There's a big difference there, right? The NBA can't just shut down 2 games. Like golf can get away with like, okay, we're not going to have a tournament, right? They had a couple outbreaks at the Travelers tournament this week. So golf can shut down a tournament. They can withdraw. You can have players withdraw, but you can't shut down games at the NFL or the NBA. You can delay in Major League Baseball. It's a concern. It's a concern I have. Look, put it like this. I'm more concerned about live sports right now than I was 7 days ago. Right.
Yeah.
The same way, I'm a little bit more concerned about the economic data right now than I was 7 days ago. I'm a little bit more concerned about the market performance right now than I was, say, 7 days ago. Right. Because in the last 7 days, we've seen some, data that's a little concerning. But, I've seen a couple things in chat on the virus. And I saw Lewis talk about how Trump says, we're seeing increasing cases because we're doing increasing testing and mortality rate is going down. I agree 100%. That is accurate data, 100%. No doubt about that. But we're also seeing alarming increases in rates in certain locations, right? And I said this on Monday and I said it again yesterday. Whatever you want to find, if you want to find a political edge where you hate certain things, then you're going to find that in the data right now. If you want to find a political edge where you like certain things, you're going to find that in the data right now. For me personally, I maintain that the positive data, for me at least, is outweighing some of the negative data, right? I think that mortality rate going down, despite us increasing testing, and none of us are experts on this, but just in my own personal viewpoint, I find that positive. I find it positive that we're increasing testing and seeing mortality rates going down. I think it's positive that it's skewing to younger generations that are, not necessarily, at risk as certain other generations are. And that shows me that people are going back to work and the older generations are still social distancing and staying at home. Again, all of us are just trying to read the tea leaves here, right? All of us are. But you're going to find whatever data you want to support your political argument right now.
All right, how about a non-data source? All right. So what do you say? Every smart person I follow, that I respect, that I read their writings, thinks this is the stupidest, most overvalued market they've ever seen in their history. Jerry Grantham. If you want to hear and go read someone really, really smart, Google Jeremy Grantham and go read anything he has to say about the market right now. Jeremy Grantham. So what do you do when everybody that you trust from a big picture fundamental, seen this, been around for 50 years doing this, is saying this is the most ridiculously bullish market, overvalued market, the stupidest thing they've ever seen? What do you say? What do you do with that data?
I don't know what to do with it because I mean, here's the thing, fundamentally and investing, I have no fundamental conviction in investing. So what I do with it, Mark, is I just continue to trade because I know that the long-term economics are terrible.
I'm not talking trading. As long as Apple is breaking out and creating pullbacks, you trade that. That's easy, right?
So I've thrown my fundamental conviction out and I'm a believer in owning stocks long-term, but I can't wrap my head around buying here and holding forever in the face of what's coming down the pipeline of the unknown. And I'm not saying we know that it's going to just kind of unravel and the S&P is going to crash. That's not my point. There's nothing that gives me the confidence that you're buying it at a good price on the broad market. Individual companies I believe in, like I might pick up a Slack or something, there are investment theses around companies I still believe in firmly. Right. So I've kind of shifted to there, but I don't disagree with those people and I don't argue with them. And I usually just nod my head and listen. But I also don't know how actionable it is to admit that the smartest people in the room are all bearish, because in the short term, it doesn't tell me what to do. It doesn't help me trade the markets in June and July. Right. And as a trader, I have to focus on daily and weekly routines to make sure my equity curve is moving forward. I'm just trade. You got to trade still. So it throws my investment conviction off, Mark. There's no question, but it doesn't change the way I'm approaching trading.
Well, I mean, trading is easy, right? Signals trade. I mean, because Apple could go to $700 and it's still whatever. Even if Apple was ridiculously overvalued here, we've all been around to know that you get breakouts, pullbacks, and go. Apple could go to $700, like just because that's how trends work. You don't try to guess it. But I like what you said about individual companies trying to focus in on companies that you truly believe in. I guess there's always something you can go find. That
you can always do that, right? You can always find something that you want to map your investment thesis around. Trading and investing is a different deal. There's no question, but you're right. There's a lot of very, very smart, very wealthy, hedge fund managers, famous investors that have all called this thing kind of crazy. Warren Buffett didn't come out and say it exactly like that, but he hasn't been buying into the market, right? His last quarterly report told us a lot about him, and we're hearing it. Carl Icahn, you name it, Ray Dalio, they're all calling it a bubble. We know it's a bubble and the economics are terrible. I do want to talk about the rest of the market here, keep moving through here. Let's work on commodities next if we can. Crude light, Matt, if you'll bring that chart up. And then natural gas actually is probably the most interesting commodity for me here today. I don't see anything really new in the analysis here. Mark, anything you want to update on crude light?
Dude, on crude light, there's not anything new on crude.
Yeah, I don't see it either.
I mean, crude's going to have down days like it did yesterday on COVID scare. Very sensitive to COVID-19. So when the headlines are overwhelming, it's really hard for crude to swim against that on COVID days. That's been a constant pattern over the last, for a long time now.
Slowing momentum, obviously. And it's a reflection of the conversation we've been having for a half an hour on stocks, Matt. It is more moving into some kind of trend change here. It's still an uptrend, but the momentum is changing there. There's no question about it. I think natural gas, though, we don't talk about natural gas every day, but we got to talk about it here today, Marky. What is going on? Is this seasonal?
Good old-fashioned breakdown,
is this? Right? Oh, big time.
You got good old-fashioned breakdown. That's just what you got. Those contracts are across the board getting sold off. All right, so basically, because when natural gas almost never makes the news, because natural gas is one of the more boring commodities there are. But with today's move hitting 25-year lows, you started to get some people out there with a little bit of analysis. Now, if you've ever traded natural gas, one of the most infuriating thing about trying to wrap your heads around the fundamentals of it is the weather, because the weather is perhaps the driver of natural gas prices. Yes, production, supply and demand, blah, blah, blah. But if you've ever followed natural gas threads, it's like following a Weather Channel groupie fest. Weather, 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 weather. Plain and simple fact is that we have not had unseasonably warm weather in the late spring and early summer in the United States. We haven't had those excessive heat waves, which plays on the demand side of natural gas. When you have excessive heat or when you have excessive cold in the winter, then there is more consumption of natural gas. Now, the supply issue is not robust. There is still an ample amount of supply of natural gas. So if you don't have extreme weather conditions, then you are not going to pull off of that supply. And if you don't have extreme weather conditions or really warm temperatures in the summer or in late spring for a long period of time, like we've had this summer, it is going to create this domino type effect. Now, trying to predict weather in your investments is the most frustrating thing I do. I dibble, dabble, dibble in a lot of things. One of the things is natural gas. How do you predict the weather, boys? You got any insight or gauge on what weather's going to be like for the next 6 weeks? Because that's where natural gas prices will be 6 weeks from now.
Very hard to predict, obviously, but that's been in a long-term downtrend here. I can't just attribute it to weather, though, Mark. I mean, that would be some random stuff, sure.
We did not have, I mean, listen, I know it sounds weird, right? But you go back to the winter, we didn't have an unseasonably cold winter either. We've had this very moderate stretch of weather in the United States for a period of time now. Listen, if anything in the entire universe was a trade what you see, natural gas is it, because I haven't figured out how to wrap fundamental and predicting weather patterns yet.
Then you got to focus on the chart. Matt, what are you seeing in the chart?
Yeah, I've heard Mark and Frank's, I've heard them geek out on weather related patterns with natural gas for a long time now. So I don't have really much to say about the weather related analysis on natural gas. I don't disagree with it, right? We've made fun of it before just because we've made fun of it before. But I think it's more than that, quite frankly, than just it's been unseasonably warm, although it is really nice out there today. I can't wait to go for a nice little stroll later on. You had supply go up today. I mean, natural gas storage, unexpectedly went up to 120 billion. The expectation was 108. Last month was 85. That economic report came out at 8:30 a.m. Eastern Standard Time here today. And, you were selling off in the face of that coming into that. You were forming a little bit of a low base type situation right here. That economic report was released and you saw that market really kind of sell off. And that's what really kind of, the weather related is this movement here, right? The breakdown is based on the economic data that we had when you came out. I mean, the market was literally trying just to hold on to that overall support level. The economic data came out and really drove natural gas underneath that support level. So yes, Mark's not wrong on the analysis that weather has played a role in natural gas, because obviously weather does play a role in natural gas, but it was not weather that led to that breakdown. It was a dire economic report that led to that breakdown. And that's a good reminder that, overall analysis can lead to trends developing. But when you force your way through a very, very important, psychological level, but also a very, very important technical level right there at about 150, your old support over here at 150, it's a 10-year low at 150. There's been a lot of evidence of buying coming off that 150. To break that 150, it's got to be some type of new catalyst, the same way, to break out of a mentality in the market. We talk about, well, it needs some catalyst, right? For the market right now, for not the NASDAQ, right? I mean, sectors are going to perform differently the same way indexes are going to perform differently. But in the S&P, don't you guys think that there needs to be some type of catalyst here to really spark that buying mentality?
Yeah.
Something that we don't know.
Which
Maybe
is
it's
why,
an economic.
well, it's why if fiscal stimulus passes and that's not the catalyst, I would be surprised, Matt. Now, I'm not saying you're wrong. It's an interesting perspective on that. I thought
I
that
said
might.
it was light. I want to be clear on that. I'm saying it's light. It's light into comparison to what we have been doing.
Mhm.
And it goes in line with the same analysis I've had for over 10 years now. If the Fed is going to continually prop this market up, they have to do more, not less, right? And what has the Fed done? They've done more, not less. They constantly if you want to maintain a bubble, guys, you got to constantly do more, not less.
Mhm.
You have to. If you want to continually drive price up to the same velocity as price goes up, you need more money, not less money.
Mhm. No, I'm with you. I'm with you 100%.
Don't you think the fund that got blown up because they were selling calls on natural gas? Don't
Just
they have
wrong
to look
here.
at this chart and be like, we knew we were right?
Don't bring up the tears. I don't want to think about that dude right now. I have made some of my mentor students over time watch that video, Matt, just to scare the hell out of them if they're overusing
Listen,
leverage.
anybody that sells naked calls should watch that guy in tears talking about how he lost $280 million selling.
Was it 280 million?
It was $280 million selling natural gas naked calls
It's
in an environment where seasonality typically has a little bit of strength on that natural gas. It was an idiotic move by the guy. It was over leveraged. It was over position size. He had no business doing what he does. And although I felt bad for him for about 5 seconds when I saw the tears, then I realized that the level of stupidity that he did with other people's money, he deserved those tears and all of everybody else's tears that he lost their money on. So I have no sorrow for what that guy did. But yes, Tim, I agree with you. Anybody that sells calls needs to look up that hedge fund that got blown up selling naked calls on natural gas.
It's Ahmad. It was called optionsellers.com. It was a hedge fund manager. I can't remember his name individually. It's an 8-minute video. It's probably still online somewhere. It's cringeworthy. I will tell you that. Watching his reaction, his emotions to it.
Whenever you are tempted to sell too many naked puts or too many, mostly naked puts, and we don't have a lot of people tackle trading selling naked calls.
That's because tackle trading is anti-naked calls. That's why. How many times do we have to say it? Don't do it.
You need to do a leverage check. You should always believe what you do in the company, but you also need to do a leverage check that if I am going to take ownership of this, where does it put me? Am I comfortable? Would I lose
stress
sleep?
test.
I don't.
You do need to do a personal stress test on this,
That's right.
both on a ledger and on a psychological.
No, it needs to be stronger than that. A naked call has an open-ended risk graph. It has nothing to do with position size. Are you willing to lose everything? That's the question.
I'm talking about naked. I'm talking about naked puts. If you sell naked calls, just don't do it. I mean, I don't know what to say. Like, just don't do it. Naked calls for naked call's sake. Do a bear call spread. Like, don't be so greedy that you can't. I mean, bear call spread. I mean, yeah.
Literally, it goes back to what I was saying yesterday. You should know the risk of every single trade and understand that risk can happen. We were talking about bias earlier. People don't like to think about the negative. They hate it, being wrong. So they just, hey, I'm just not going to think about that. They always think that they know exactly what the market's going to do next, and no one does. So you need to understand exactly what you're putting at risk for every single trade. And that's a great example.
I mean, I don't know anyone personally, but someone sold a naked put on Tesla in the last year that got blown up, right? It exists out there.
Well, people over leverage, Mark. I mean, it's not just naked puts. It's in futures, Forex.
I mean, a
and
naked
any
call.
other
Did I say naked put?
Or even a naked call, naked put. Any
somebody sold a
you
naked call on Tesla. Be like, 450. There's no way it can go higher as it went to $900.
Right, and it's an important point. But the issue is not just short options. I've seen over leverage on all kinds of products. Anywhere there's leverage, there can be. Which, by the way, it actually brings up a nice transition into our next story. Give me XLF if you can.
There you are with your golden transition.
I don't know if you guys saw this story here today, Matt. Two big things happening with banks and investment banks specifically today. Goldman Sachs, JP Morgan, Bank of America, Wells Fargo, they'll all be affected. Bank regulators are proposing loosening the Volcker rule that was put into place after the 2009 financial crisis and the over leverage through derivatives. And Matt, some of the proposals that I'm reading on that just make me scratch my head what they're doing.
am dying a little bit as a capitalist every day.
I've been waiting all show for you to bring up this so I could get Matt's take on it.
It's if you want to see the bubble of all bubbles, reduce regulations on the banks. If that's what you want to accomplish. If you want to accomplish massive valuation, and if you support massive valuation and massive crashes for the next 50 years of your life, where you have massive appreciation followed by massive depreciation, then reduce regulations on the banks. At no point in our history have the banks ever supposed to be one and the same. And just to remind people, there's two versions of banks. You have investing banks, you have lending banks. There's two very important regulations that have happened in our history. The first one was 1933, when you had the Glass-Steagall Act segment the banks, because following 1907, banks started merging together with the currency crisis of 1907. And by the 1920s, most banks have merged together to where lending firms could also be investing firms. Now, what that means, guys, is when you put your money in a bank, what does the bank do with it? They don't just loan it out, right? They monetize the money you put into the bank, and they monetize the debt you have at the bank. And that's what happens when you merge these banks together. The lending firm will lend Noah Davidson money to buy a mortgage. The investing side of the bank will monetize that debt to offset the debt off their books to reduce the debt exposure. What that means is they won't care if Noah is credit worthy to borrow $400,000 for a home loan, because they're just going to offset the risk through monetizing through the bond market. And what that does, it encourages the lending firms at the bank to loan out more money to people that, quite frankly, or obviously cannot afford the loan. And that's what we call a predatory loan. And they don't care about that, because what happens is they just monetize the bond process is what they do, which means they shift the responsibility of risk from the bank loaning the money out to the consumer who takes the loan, because even if they don't knowingly understand the risk they have, because they have a 401k and they own bonds, where are those bonds coming from? That's what a mortgage-backed security is. That's what a subprime loan is. That's what we saw in 2008. And in 1998, you saw the reduction of the Glass-Steagall Regulatory Act, which means you eliminated it. Well, what happened between 1999 and 2008? Banks merged together, over-leveraged their environment, created a predatory loaning environment where literally Moody's was and the S&P were, rating these bonds as AAA bonds, despite the banks knowing full well that the debt incurred in the bonds were from people who could not afford the debt, which meant in 2008, when the market crashed, not only did the consumers lose their job, not only did they, lose their savings, not only did they lose their home, but they lost their 401k, which was allocated in mutual funds that had a lot of mortgage-backed securities in them, because they were triple rated despite the type of debt that was actually in the bond. It was criminal, in my opinion, what was happening. In 2010, the government came out with a modified Glass-Steagall. They didn't bring back Glass-Steagall, but what they brought back was the Dodd-Frank Act. And the Dodd-Frank Act was the regulation that, put some type of regulatory pressure on the banks doing the same thing that led to the initial crisis. One of those rules is the Volcker rule, named after one of the greatest Fed chairmen in our history, Paul Volcker. And what this rule does is it basically stops banks from speculating on your money, so that when you put your money into a bank, the bank can't use their money and your money to speculate in the financial world, right? Because when the bank uses your money and that bank is FDIC insured, they over speculate, they over leverage themselves, because if they ever lose their money, they're losing your money too, which is federally insured, which means it removes a certain risk parameter from them. And what the Fed did today, or what they're pushing out there, is the elimination of the Volcker rule, which would allow banks to over leverage themselves and over speculate themselves and create more bubble-like condition. It honestly is good to be a bank, but this is bad for American consumers, in my opinion. I am of the old school proponent that I personally think we should bring back Glass-Steagall. I do not believe Goldman Sachs should be able to trade your money. I don't. Goldman Sachs is an institution. They are an investing firm, and that's what they should do. There is a massive conflict of interest when you merge these banks together, and the elimination of the Volcker rule is a big mistake, in my opinion, and it's done to maintain, to give the banks a little bit more freedom to do what they need to do. Because quite frankly, I also think you're going to have some banks fail the stress test today, and I don't believe you're going to realize who those banks are, because the Fed's not going to be transparent in that.
Well, I mean, that stress test tonight is something, Mark, you've been talking about all week. Obviously, these big storylines around this deregulation thing, it's got to be concerning to anybody who understands markets. And Matt, that was an excellent breakdown in some of the history of it and whatnot. Mixing those two types of firms, it just does not make sense to me from a strategic perspective when you're setting up the industry. But it looks like they are going to move toward deregulation, Matt. It seems like that's what the Fed wants to do. And maybe that is because they know it will create more bubbles. You know, it's a roundabout way to keep the bubble churning. I don't know, but it's got to upset
they will
anybody.
do anything to keep their fat bonuses coming at the banking level, because who do you think Jay Powell's friends are? Jay Powell's friends are not you and I. They're not Main Street America. And where do you think Jay Powell's going to work when he unceremoniously leaves from the Fed? I guarantee you he has a nice multi-million-dollar contract ready for Jay Powell at name your bank. Goldman Sachs, Deutsche Bank. Please, God, make it Deutsche Bank.
Didn't Bernanke go work for Citadel?
Yeah, Bernanke went to work for Citadel. That's what they do. They come from Wall Street. They go back to Wall Street. Citadel is the largest high-frequency system in the world, and he sits on the board. So yeah, I mean, Jay Powell's doing his friends a favor here. He's not doing Main Street a favor, I can tell you that.
Yeah.
French Revolution too. I want to see Jay Powell in a 19th century French wig, because this is, I mean, listen, some of the deeper writers out there that are really, really good. I mean, the wealth inequality, which really we don't talk about a lot because it doesn't have any bearing on market action. I mean, the wealth inequality that is created through Fed policies is ridiculous. I mean, just, you can comment further on that.
A homework assignment for our team, just go out and do a little bit of research on what Glass-Steagall was and why it existed in the first place, because there's a plethora of historical evidence on what these types of regulations do and what ultimately comes out of them.
Can you even get a powdered wig these days? You know,
dude, you can get anything these days. Go to Etsy.
In fact, everybody, all of us
eBay.
coaches that tackle trading, there has to be a bet that we need to make to where the loser of that bet has to wear an 18th century, British wig for the entire week on the halftime report.
Dude, I'd wear one. I would lose on purpose. I think I could rock that nicely.
You probably have one in your closet for, games you play.
Listen, what goes on at 11 p.m. in the Justice household is none of your business.
I know a couple of kids in Australia that you could hire, to come on over to your house.
Go watch Trading Justice Podcast 2 podcasts ago to get that inside reference there.
All right. There's not much going on in gold and the dollar. You could peek at the chart if you want. There's nothing there, though. I mean, the gold charts, doji here today, same analysis that we've had for some time. The dollar hitting some head into resistance. I guess a little bit more confirming there. Matt, you see anything you want to update there on gold or the dollar?
I can repeat what I've been saying for months and months and months if you want me to.
Nah, let's not do it. Let's talk next and move into individual companies and start talking about some of those. We've already talked about some of them so far here today. Earnings on KB Homes. We'd mentioned Disney, shutting down their theme parks and whatnot. While we're in stock talk, couple of programming notes here for tonight. Last night, we had some issues running our Zoom for our Step System Mastermind group. So Noah, we've got that rescheduled here for tonight at 7 p.m. Eastern. We've got Zoom up and running. running. We believe we've double tested it, triple tested it. We will make sure that it does work. And we're here on it right now, working with it. So we're going to be ready to go, but that's going to be tonight at 7 o'clock Eastern time. So if you are a STEP system student, make sure you come tonight. Join us at 7 p.m. Eastern. You can access that from the events page at Tackle Trading, the way that you normally do, or from the STEP System Mastermind Group page. I'll also make sure we tweet out that link for those pages as well. But then the other one is we still have our Thursday night cash flow club. And Mark, who's teaching cash flow tonight? Is it Tyler?
Tyler is going to do, 2 weeks ago, he did a class on Fibonacci retracements. I think he is doing a class tonight on Fibonacci extensions. So if you wanted to become a pro member, take advantage of a 15-day free trial just to watch a couple Fibonacci classes, this would be a good time to do it.
You know, and the last thing on if we ever have any issues getting into a show or getting into your account, the fastest, best way to get a hold of Tackle Trading is to buzz an email to team@tackletrading.com. Usually I'm online with Mark and he's double checking those and we are problem solving. So make sure you guys check out those shows here tonight. Zoom's I need to talk to Zoom, Matt. I know they've had security issues and they've had account updates and all kinds of stuff. Maybe they've got a little ahead of themselves here because they're not handling accounts. We've had issues with them for 2 weeks. You know, we had a problem going live on the halftime report. Can I short Zoom out of spite right now?
Dude,
That's why I brought up Zoom's chart. Is usually when we have problems with technology, we're like short X company. Only if you want to lose money. That's it. Zoom's a freight train here. And I brought it up, and when you were talking about Fibonacci, I so wanted to do like a 10-minute long form conversation on Elliott wave and Fibonacci projections, just to get our team excited for what Tyler's going to teach. But I will not do that. I will not do that.
If you want to do 10 minutes on Fibonacci's, you know, I could go check in with my wife and see what we're
Oh
doing for
man,
lunch.
you want me to 10, 20?
You let me know.
Listen, I will get the camera and I'll go on the whiteboard and I'll start whiteboarding Fibonacci and teach everybody about Elliott wave. Actually, we should do that. I should get the whiteboard up.
You should do a special webinar for that, Matt.
Yeah.
Me in front of a camera, whiteboarding.
Yeah, let's do it.
You know, I did whiteboard a 3-day presentation most of the time, so I think I could handle it.
You know, if you're truly going to do a whiteboard Fibonacci presentation, you can draw like pictures of flowers and snakes and say it's all built into nature.
Oh,
and,
I could make up anything I wanted.
Cody, no,
Tim says that sarcastically, but
it's just math.
I just triggered Cody.
Yeah.
I'm just trying to get after you there, Cody.
See, that number does repeat itself so many places, and that does include nature.
Bird flocking patterns, sunflowers.
Sacred geometry.
Listen, that was Tim just admitting he hates math. He hates it. He's an anti-math geek.
Math fight. Yeah, no, I hate Fibonacci analysis. But we are not going to rehash that again. Let's talk companies here today, guys. You know, Beyond Meat first here, Matt. I want to talk about this one. There's so much hype around companies like this.
Before we get going on anything serious, I read a thing yesterday that in COVID-19, 1/3 of Americans have gained weight. Now, my girlfriend made me get on the scale.
The other 1/3.
I wouldn't. Yeah, go ahead.
And I am in that 1/3. I've gained weight since COVID-19, more than I would like to admit as I eat a cheese steak.
All right, I have.
Don't they call it the COVID-19? Like that's the average number of pounds people have added on.
I haven't heard that. I like that though.
Is that like the freshman 15s that spin on that?
Yep,
Yeah,
exactly.
So any of you guys in this bunch, have you gained weight since COVID-19?
Oh my goodness, I've eaten too many candy bars.
Yeah, I put on a few LBs. There's no doubt about it. But you're talking about gaining weight while you're eating right now. What are you eating?
I'm eating a cheese stick.
Can we analyze Peloton right now?
Maybe we do. Maybe we do need the stay-at-home workout stocks. I just want to make sure I go for walks every day, Maddie. That's one of the best things I've ever done in my life. And you get stuck in the house. I think we all naturally, you're eating at home, you're doing carbs. We eat a lot of pastas and whatnot. So Mark, I've put on the COVID-19. Yes, using Noah's line there. What are you going to do about it?
One of the smartest trades you could have done, well, basically you could have bought anything, right? But long Peloton, long Planet Fitness, knowing that someone was going to win and they both skyrocketed. Like,
that would be an interesting pairs idea. Yeah. Yeah, definitely. Let's talk some of the companies here. Back on Beyond Meat for a minute, Matt. This one is one on my watch list. I frequently trade this company like a lot of traders do. I don't have fundamental conviction on this stock. A lot of people don't. Not good news out of the stock this week. They lost a deal to Impossible Foods on that Starbucks stuff earlier in the week, and McDonald's pulled out of their deal in Canada where they were putting Beyond Meat burgers on burgers in Canada, and they said we no longer want to do that. It's a reminder there's competition in this industry, and a lot of this kind of thing, when the stock pops, it's usually news based, but it hasn't proven itself yet there. Matt, that chart is kind of changing here a little bit. Do you think there is any bullish opportunity if it broke out or anything like that, or are you seeing it differently?
No, the only trading opportunity as of now with the analysis you just put out there, Tim, is a breakout. I mean, that's what happens. I mean, you got a bullish uptrend, you got some negative news at the top end of the trend. It shifts the volatility, shifts the price action. Then you got to wait. Because if you do break down, you got to wait to have a double bottom of some capacity. So as of right now, if you're looking to trade Beyond Meat, you're still looking at that as a potential breakout. You're not looking to pick it up on the lows, in my opinion.
Yeah. Next one, KB Home. Home builders are some of our favorite to analyze. They had earnings last night, and the CEO actually came out and said, rising unemployment is leading to cancellations. I read some of the quotes he had in the earnings conference call, Matt. A little bit concerning there. And, I loved the pullback on KB Homes when it came back into the 200. The earnings date would have prevented somebody from trading that, and it didn't materialize. I've been interested still in home builders, as anecdotal evidence in real estate markets has shown some relief still in real estate. I mean, especially like even still here in Utah, I'm still seeing strength in prices and whatnot. But that chart is now changing. It's kind of reflective of the broad markets here, Matt. With those pivots coming in, we're playing defense, but we're not getting price appreciation. Does it change the way you would see KB Home at all, hearing some of the commentary and a very light earnings report from them, by the way, but some of the commentary from the CEO about cancellations on their homes?
I don't know about that, and I don't look to trade KB Home, so I don't know how to answer the question, to be quite frank with you. But in terms of the actual numbers here, it came in slightly under EPS of 55 cents versus the expectation of 57 cents. Revenue missed as well, coming in at 914 million versus the 1.2 billion. Revenue fell 10.6% compared to the same quarter a year ago. So obviously KB Homes had some negative information with the miss on both revenue and on EPS numbers. The revenue decrease from a year ago is also concerning, but not unexpected given the fact what we're going through this year in comparison to what we were going through last year. We're going through a trade war last year. We're going through a pandemic this year. You tell me which one's worse for home builders. So, in terms of that, no, I'm not looking at buying or investing in KB Homes. If I had to rank all of the home builders from a fundamental perspective, KB Homes would be 5th out of 5.
Yeah. Does it affect the way you see other home builders when you hear a report that's lackluster, or when you get concerned about one company in a space? Like, I know that some of the other home builders, like out of the 5, what do you got ranked one, by the way?
Well, I think the from a fundamental perspective, I think DH Horton is probably the more fundamentally strong. Yeah, DH Horton is probably the number one fundamentally strong company. Toll Brothers, TOL. Toll Brothers, I think, would be second in line from a fundamental group. What's Pulte's symbol? Is it
PHM?
PHM. Pulte would be third from a fundamental perspective. I'd say DH Horton would probably be 1A, and then Toll Brothers, Pulte right after that. That's how I'd rank them. But let me just say this about the residential real estate market, because that's what these companies are. They're not big time commercial real estate companies. They are your home builders, right? They're going out there and putting up residential properties. I think we're extremely early on to see the level of damage or lack thereof in residential construction right now. And it's very similar to the data you're seeing from a COVID situation. If you want to find positive data out of COVID, you certainly can. It's out there. If you want to find negative data about COVID to support your argument, it's out there as well. From a housing perspective, we've seen really, really good numbers from a housing perspective in the last 2.5 months. We saw mortgages increase by 17% last month. We've seen home values maintain themselves in the last month. But we've also seen some negative data coming out of there as well. 2.5 months ago, there was a report that 50% of homeowners were considering selling their home when the initial wave hit. So I think we're really, really early on to assess the data in the residential construction, because the simple reality is, in many aspects of the financial world, you can quickly assess where things are going from a revenue versus a expectation. You can understand economic trends and economic reporting trends and political trends, and you can start to get an identification of probability and analysis where you think the market's going to go based on that data. But when you're talking about real estate is a very, very slow moving beast, right? And so, Tim, you mentioned that housing values have maintained themselves. Well, yes, housing values will maintain themselves until you start to see increasing supply and decreasing demand. And that takes time in residential construction. Simply if you wanted to buy a home today to where you are actually paying for that home, you're talking 2 months. Is what you're talking. And so in 2 months, the amount of things that could change. And KB talked about that, about how, they're seeing a rise in cancellation. So, I think we'll have a much, 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 much better understanding of the economic damage or lack thereof in the housing, and specifically the residential housing, 3, 4, 5, 6 months from now, after we see what true supply and demand is really going to start building. Guys, the market turned over in June of 2007. It wasn't until mid 2008 to where you really started seeing the ultimate destruction in that residential construction area of the market. Real estate is one of the most lagging markets in the entire financial world. And so I think we're very, very early on in that overall analysis of, once again, how extended is the damage in this area of the market, or are we over valuing that damage to a certain extent? I think we're early here. I really do. I'm personally not as concerned at this point with residential construction, especially if we get a U-shaped economic recovery. I think everybody needs to stop talking V-shaped economic recovery. I think that's false hope. But if we get a standard U-shaped economic recovery, I'm not nearly as concerned about residential construction right now as I was in 2008. In 2008, guys, that was the bubble. The bubble was construction. It was residential property. It was the subprime loan. Whatever creates the bubble is usually the one that gets hit the hardest. Real estate has not been the bubble this time. For the most part, things have recovered, but we haven't seen massive appreciation off those highs of 2007, 2008. So in terms of the tech bubble, that got hit the hardest. Technology went down 90% in the .com. The banks and the real estate went down 85, 90% in 2008, 2009. So right now, real estate was not really where the bubble was, in my opinion. I don't expect it to get it hit as hard as some of those other areas of the real estate market, like commercial property. But I still think we're very early on in the analysis of where the damage and the lows really is in the residential construction area of the market.
Yeah, and if you look at all of those charts as you flash through them, Matt, one thing that just kept coming to my mind, and they feel like they're moving neutral. Trend lines kind of violated. It's not like they're bearish yet. Pulte's sitting there on support, and you do have a rising 50, but you're below some other moving averages. A lot of them just feel like they're moving into some consolidation here. Playing defense, sure, at support there on D.R. Horton, but I kind of got a very neutral read on that. Do you guys see that as well?
Yeah. You had bullish uptrends coming into all of them. You're seeing it across the board in these companies. DH Horton double top there at 59.5, double bottom right there at the 200-day moving average. Taking a look at Toll Brothers, you're seeing a very similar analysis. Double top at the 200-day. Support, trying to hold support at 30. So when you're looking at PHM, same type of pattern, double top, double bottom. This market is correlated, obviously, with all these residential construction companies. DH Horton is my favorite. And if you're looking at investing in this area in the market, I would look at DH Horton. Number one, it's fundamentally stronger. Number two, it's technically stronger. Number three, it's holding its 200-day moving average, playing support instead of playing defense on Toll Brothers and Pulte. And obviously they don't have the problems with KB Homes has today. So that's where I'd be looking. Plus it's a tackle 25 stock, which means, it has liquid options. You can write calls against it, bring in a little cash flow if you have any expectation of downward movements in price.
Boeing next, if we can. Mark, you brought this one up in pre-production, and obviously we were talking about this one at length yesterday. A little bit of a move down here today. A couple of news stories out of Boeing. Mark, I believe you told me they raised their dividend, number one, but they also got a downgrade. Is that
Kroger
right?
raised their dividend.
Oh, Kroger dividend, but the Boeing downgrade.
Yeah,
Boeing don't got the cash to raise a dividend.
Do they even pay a dividend right now? Didn't they cancel it?
They suspended that.
They suspended it. I don't know if they reignited it, but they did suspend it.
They don't have the cash to do that. They got big structural problems right now, you know?
Yeah.
I did. Boeing's not raising dividend. I was going to be shocked at that.
Pretty interesting, though. Obviously down 2%, but a flat out downgrade by one of the firms, Matt, and it's not exactly selling off aggressively. You get a natural reaction to any upgrade downgrade that happens almost every day in the market.
What, negative orders for 6 straight months as a downgrade? Okay.
It makes sense to me, but it's got support.
You're not delivering planes and people aren't flying. Oh yeah, downgrade.
I think they just downgraded Enron too. So
yeah.
If you trust anything, listen, I have no doubt there's an analyst out there that is just fabulous that works for one of these, right? Just the smartest guy in the room you could trust. But most of these monkeys just follow price. That's all they do. Like Wedbush, like
the JP Morgan analyst on Tesla.
They just jack price. You know, it's like, oh, Apple's up a lot. Let's raise our price target based on nothing other than price. It's actually pretty comically bad.
Mm-hmm. You still interested?
Boeing got a nice little traditional downgrade from a hold to a sell. It wasn't from a buy to a slight buy. I mean, it was who was it? Bernerbag? I don't even know who they are.
I don't know the firm. I read it and I was like, I don't know that firm, but I did see they had coverage and they're an analyst. And
we did say the tackle trading firm and do our own upgrades and downgrades. Can we do that?
Might as well. I mean, we.
What would you downgrade today? Every coach.
GE. Downgrade GE. Can I have my own ratings? Can we call it a dumpster fire instead of a sell rating?
Oh yeah, we would have very creative ratings to tackle. I would downgrade, honestly, Mark. I would downgrade Deutsche Bank just to make myself feel good, but I also think that's what some analysts do when they do their upgrades and downgrades, is just to make themselves feel good. A stock that is overvalued that I would downgrade Beyond Meat today.
Mm-hmm. Yeah.
I think the combination of the Starbucks news as well as the McDonald's news losing Canada from a Beyond Meat. I mean, that's one of the reasons why, people were so euphoric about Beyond Meat for the last couple of years.
Timmy, what else are you long? Because I was going to go with Beyond Meat.
I would downgrade Zoom. That would be my answer. I'm not, not happy with Zoom. I would. It would make news, by the way. I'd make it a sell rating.
What do you think the most overvalued stock in the market is? And that's saying something, right? Like
it might be.
You're mute.
I'm on mute, but there's too many to choose from. Like
there's a lot to choose from. What's the most overvalued stock in the market?
Well, Nicola's never made any profit, so I don't even think they've ever sold anything. So you can downgrade them just based on valuation
but they've got
alone.
a cool symbol, and that's worth a lot, just right there.
Yeah.
I think Beyond Meat's the answer, to be honest. If you're really looking at this from a fundamental perspective and not from a technical
Matt, it's about the future. It's about the future.
I agree, but the future was supposed to be Starbucks and McDonald's, and now it's not. It just removes, when you're looking at Beyond Meat, it removes one of those reasons, one of those theses of why people believed in this company in the first place. Is it wasn't just the mentality that consumers are going to be buying Beyond Meat products at the grocery store, for example. How many times do we see that over the course of that rise that Beyond Meat had as it was driving up after its IPO all the way up to 240? Is like, oh yeah, they're going to get into like Taco Bell, and I was at like the taco shop, and they like had a fake meat Beyond Meat burger, and like price was going up. So if you remove a little bit of that, I mean, let's face it, guys. Losing Starbucks to a certain degree and losing McDonald's in Canada that's major cold water on one of the long-term bullish theses for Beyond Meat, especially after Beyond Meat in this recovery has driven up 200% from the lows of 50 all the way to 150. I think Beyond Meat's an easy downgrade, to be honest with you.
I don't like it.
Listen,
I'm long
I'm
Beyond
sorry.
Meat. I don't like it.
I know, I know, but I mean, I guess, Tim, intraday, you did hold intraday support. So there's that.
Well, I built a position trade on the breakout a few weeks ago. I've got long-term bull call spread on this. And if it does break support, I would get rid of my trade. You know, I have a trading plan. I'm going to follow my trading plan. Probably will.
You know,
It'll probably will
I'm
happen.
looking around all of my symbols. I don't know what's not overvalued right now.
That's a fair point. I don't know. You brought up Kroger earlier for some. I mean, this tells you a lot about where Mark's head at is in the market. The one stock you want to talk about today, Matt, was Kroger, the food company, because they raised their dividend. I think all these other overvalued stocks, Mark, they're not grabbing your attention, are they? You like that safety food company picking up a dividend type thing?
Well, I had a naked put expiring tomorrow at 29, but that's not going to happen. So, yeah. No, I like dividend because at least, like, let's say I get put Pfizer, right? Like, this market's crazy, right? And let's say, you know, I got some money to stick there, whatever. I pick up Pfizer with a 5% dividend based on whatever belief. And I'm not saying buy Pfizer. I'm just using Pfizer example because I know what their dividend yield is off the top of my head. Man, as long as you believe that that dividend is safe, you know, which means not oil and gas, right? I don't know if you could say with an absolute certainty there. Maybe not banks. We'll find out a little bit more. But like Pfizer, you know, probably safe. I don't know. There's just something about dividend yields as a portion of your portfolio that it's boring, right? It's terribly boring. But man, it's something to do with your money as you figure out, as long as you believe in the company, believe that the dividend yield's safe, and believe that you're getting it at a reasonable valuation. You know,
a lot of those are
exciting
very,
to talk
very
about,
open. A lot of those are very open questions, though, because dividend does not offset loss.
No.
A 5% dividend in a year doesn't offset Pfizer going down 40%.
Well, if you're never, I mean, that's the whole thing. Do you have a plan? Do you believe in the company? There's so many million
point
factors.
Is that I think we're about 9 to 12 months early in the dividend conversation. And quite frankly, wake me when we start to see news headlines day after day about companies increasing dividend. Until you start to see those headlines, I don't think the dividend argument is going to be a one that plays out in the market.
Oh, I think the dividend market absolutely will play out in the market at some point once COVID-19 ends, once the crazing of it ends.
Yeah, but you got to start. Yeah, I mean, when you're talking about finding real lows, you're not finding a low with an average dividend payment in the S&P at 1.6%. That's not going to happen. That's not when the value investors like Warren Buffett are going to push their chips into the middle of the table. They're going to have to start to see industries, sectors see increasing dividend across the board to where you get to an average dividend payment to where you really offset that traditional risk to the downside. And I quite frankly, I think we're really early on in that conversation too. I think it's very similar to the housing conversation. To me, you're still in this initial phase of companies reducing dividend exposure. You know, are the banks going to reduce dividend? Are the energy companies going to reduce dividend? I think that's the conversation that we're going to be having over the next 3 to 6 months. And then in 6 to 12 months from now, when we really start to see economic data starting to support a bottom in the market, not technically, I'm not talking about price action here. I'm talking economically, to where, like, we were making fun of, what company were they? Oh, Boeing. Boeing doesn't have the cash to increase dividend. Well, Boeing's not alone in that right now. Most companies in the market don't have the cash to increase dividend, which means if anything negative economically happens, they're probably going to reduce dividend. We're not there yet from a dividend perspective. We need to see data come in to support a trend developing on industry-wide, sector-wide increasing dividend before you start to really see that value play take hold long-term.
Well, yeah, but you're not, I mean, I'm going to push back a little bit because you're not there on anything. Like, under that, like, I got to do something with my money. I can't be 100% in cash, right? I'm going to have a couple trades on, but I got to do something with it.
Buy equity and gold.
You know?
Do that.
By what?
Buy equity in gold. Do that.
Well, I
with
know,
the
but
cash.
what equity, right? Because, and that's what I'm going to push back on, because I could make a similar argument on the valuation of Apple and Microsoft being absolutely insane. Now, I'm going to trade that to the short-term bull side, but invest in that? Absolutely not. Those valuations are
I
not
don't
cheap.
know. 22 P racio on Apple's not completely.
Dude, those valuations are ridiculous. They're not cheap, right? They are not.
I'm not
cheap.
saying they're cheap, but let's not assume Apple's, Zoom with the 2000 PE ratio right now.
Well, yes, compared to Zoom, they're the cheapest thing in the world, right?
But a 22 P ratio in the face of tech being 34, I would see relatively Apple still cheap in the face of what the broad market is, though. If the broad market's 30 P ratio, Apple's sitting at a 22, you're still undervalued in Apple relative to the market.
So basically, I like, for me, it's an easy call. 1,100 shares of Pfizer versus 100 shares of Apple. I'll take that bet in this market any day.
I would obviously disagree. I think the 100 shares in Apple would be far, far wiser from a long-term investment than 1,000 shares in Pfizer. The position size is the exact same against the portfolio. The only conversation you're really having is, would you rather get a slightly higher dividend on the weakness of Pfizer or the strength of Apple?
In this particular, now, this isn't an always thing, because sometimes, sometimes things are cheap, sometimes they're not. I just think Apple is ridiculously expensive right now.
But Apple's not expensive because its price tag is, $361. That's not why Apple's expensive. Apple's expensive based on PE ratios and relative to the performance. Well, I know, but relative to the performance of the sector and relative to the performance of the industry and relative to the performance from a P ratio against the broad market, Apple's still cheap and relative to what we're seeing across the market.
They got a 4P ratio of 29. That's the highest it's been, and I can't even remember when. So, that's not cheap. There's just, I don't know. There's not a chance I'd do that now. Apple probably goes $700 in the next 3 weeks.
I also don't give a lot of credibility to people who throw out forward PE arguments, though, because that's what people expect 12 months from now when there's too many variables at play. What are they doing today? Right now, they're relatively cheaper, despite the fact that they're up 25% year to date. They're relatively cheaper than the entire marketplace.
Well, Apple's relatively cheaper than the entire marketplace?
Apple is cheaper, absolutely 100%. Apple is cheaper relative to the broad market. Absolutely 100%. I would love you to challenge me on the data on that.
I'm going to agree to disagree. I think anyone who buys an Apple now is gambling, pure out gambling.
But yeah, buying 1,000 shares of Pfizer instead of 100 shares of a strength company I just don't understand that logic. I just don't.
It goes to mindset. Mark's a bottom fisher. He's a counter trend trader.
It's like Pfizer's going to, if there's a massive correction, and this is the basic difference between it, Pfizer's going to diddle dolly somewhere in the high 20s, low 30s, and probably just flatline there, where Apple could have massive price depreciation in a massive market correction. That's the main big difference. On that.
So what's the worst case scenario on Apple? 40-50% down? Worst case?
Well, you could apply it to anything. Now, do I think any of that will happen with a Fed backstop? Probably not, right?
But I don't know. I personally think you would bet on Apple every day for the rest of your life against Pfizer, and you would have a lot more money at the end of the day.
Mark, I got a question for you on these dividend and low PE stocks. Don't you think there is a risk for an average investor who doesn't really know how to look into fundamentals just to pick low PE companies and get into a value trap?
Investor just to buy a brand name because it says Netflix or Apple or Microsoft?
Oh, I'm not even talking about Apple. I'm just talking about low PE ratios. I think I saw this for years with GE, by the way, and I'm not bringing GE up just because I always rant about it, but I saw it for years in my ballrooms. I'd have people come up to me and say, well, GE's a
fundamental analysis is extremely hard. It is extremely methodical. It's extremely time consuming because you can't just look at metrics. Mm-hmm. You have to dive in. You have to understand the products they're selling. You have to understand their market share. You have to understand the trends of where they're going, and then apply all of that research, which takes a long time because you can't do it on every company, right? You have to pick a few companies. Somebody read once, if you spent an hour a day and you spent 15 hours a day, you would barely get through all of the companies by the end of the year. You know, so you just don't have time to do that kind of research on every company. It helps when you pick something that you know a lot about already, or are really, really curious about. Or maybe I'm like, I don't know anything about clothing, which is why I never invest in clothing manufacturers or this or that. I don't know anything about them, but maybe you do, right? Maybe somebody does. And so they have this like maybe natural insight into the company itself. And that gives you a big head start, but it's really, really, really time consuming. Trading is much easier. You know, you could go take step system and take technical analysis 101 at Tackle Trading and learn options and get this foundation of trading, and then go to the lounge and ask Noah and Gino and Tyler, you know, and refine that. Trading's easy because all those charts, all those 5,000 charts, technical analysis is the same on each and every one of them. Now, yeah, some stocks will have a little bit different personality, but technical analysis is technical analysis is technical analysis. And so that transcends the chart. Once you put in the time to learn that time set once, you got it. Fundamental analysis, it takes a lot of work. It really, really, really does. And so like, but do not, to answer your question directly, do not just go look at a couple ratios and make your decisions on that. That's not the way to go. That's not there's not an easy path.
Sure. I mean, you got to think about return on equity and earnings growth, earnings projections, where the company is in the business. There's a lot to it. I mean, Matt, you know, when we build our Tackle 25 list,
there's 1,000 data points in fundamental analysis, but I'm going to push back on that, Mark. I don't think investing is harder than trading.
I think trading's by far harder than investing. Investing can be really, really simple if you allow it to be.
Well, from a time consuming, I guess, is my main
No. I mean, why do we have to just discount the teachings that Benjamin Graham gave to Warren Buffett, or that Warren Buffett gave to Peter Lynch, or that Peter Lynch tried to pass down to other generations, or that John Bogle tried to pass down to other generations? Investing does not have to be hard. We make it complicated because we have our internal biases. But the simple reality is, invest in companies you know. Look at a few of the data points: PE ratios, PEG ratios, debt to equity ratios. You don't have to be the master of 1,000 different data points. Honestly, I don't think it has to be hard. I mean, regardless of the conversation you and I are having about Pfizer versus Apple, I'll take Apple every day of the week from a trading or an investing perspective. But that's personal perspective, right? That's personal bias to a certain extent. But the reality is, value investing does not have to be difficult. It doesn't have to be hard. What was Peter Lynch doing back in the 1980s? He was going into strip malls to seeing where the foot traffic was. That had nothing to do with the 1,000 data points. And yet, what did the Magellan Fund do for 25 consecutive years? Destroyed the market performance. And it literally was as simple as, let's see where the foot traffic is going. Now, obviously, that's the 1980s and not today. And it's certainly a little bit more complicated than in 1952, when Benjamin Graham asked Warren Buffett what he wanted to buy. And he said Coca-Cola, because he liked drinking a can of Coke. And yes, has Warren Buffett missed out on metric rises in crypto and technology and other things because he didn't understand it? Yeah, but he understood he liked Coke. We don't have to make things complicated. Investing doesn't have to be complicated.
I agree with the message. Can you tell that to Benjamin Graham 90 years ago and tell him not to write 900 pages in his book? Because he could have, it's a great book, but he could have said it in 200 pages, I'm guessing.
He was an academia professor at MIT. You think he's going to put it into layman's terms?
Yeah. Oh, I love that old quote from George Orwell, though. If you say something simple, if you can say something simple or complex, choose simple. It's a lot better. I agree with that messaging. I think it's a great conversation, guys. I think it would be a wonderful conversation for a podcast, actually, having some of these talks about dividends and how you're picking things.
Dude, you know I hate
but we do.
I've already spent a month's worth of argument in the last 15 minutes. So
I don't think there's necessarily, it doesn't have to be an argument necessarily. You have different perspective and different take on it.
People disagreeing on a video on CNN. You know, it's like I've become like let me a beer. And
when you pick Pfizer over Apple from an investing perspective, you're going to have pushback.
You just
Oh,
are.
I don't
Yeah.
think it's even close, but that is a whole different conversation in this marketplace. So,
Mhm. Again,
Pfizer
perspectives.
or Apple. You don't think it's close?
no, not in this, dude. But I'm coming at this from a broad perspective that this whole thing is really, really overvalued. You know, and I guess I'm coming at this from this bearish tint that you could see stagnation, if not 10, 20% correction, and trade in this massive range for years. So under that environment, now, so that's the basis in which I'm basing it on, which really hurts trends as
Well,
a
and-
general
and
rule.
I obviously disagree because I think everybody should invest in Apple.
So at any price.
No, not at an ADPE ratio. I wouldn't say the same thing about
But
Amazon.
at this price,
I
it's
wouldn't
fine.
say the same thing about Facebook. I wouldn't say the same thing about Google. I wouldn't. No, I wouldn't. But I would say the thing about Microsoft and Apple. Are they more overvalued today than they were 5 years ago? Yes, the PE ratio has increased by 7. It's went from 15 to 22. And quite frankly, I just don't believe as a value investor, a 5 to 10 PE ratio is actually a good thing on Pfizer. Energy and finance has had 10 PE ratios for years. They've underperformed the market for years.
Mhm.
I'll
I
bet
think
you
what
a
it comes
steak
down
dinner,
to.
2 years. Like a
We're going to
really
come up
nice.
with a better bet, by the way. I thought we were going to have some big sweeping bet about a wig. Isn't this the perfect time
See,
to
but
bring?
I
the
would
wig bet
actually,
in?
dude, I think the wig thing would be cool. I'd love to see Noah in a wig.
Noah has a Trump wig.
Noah
I think.
has a wig. You think Noah
He has
doesn't
several
have a
wigs.
I have more than one wig. I'm not sure why I have multiple wigs. And a couple
We'll do
wigs.
the wig bet here. Why don't we do that? What's the timeline though, Mark? That's the problem. If it's a 2-year bet, I'll forget about it.
I may lose this, but I'm shocked. I'm getting like Apple versus Pfizer here. Like
I'm talking
Like,
about
straight
total
up in my
cash
mind.
flow 2 years from now, total cash flow, total return on investment 2 years from now.
With covered calls every 30
no,
days.
no,
1100
no,
shares.
no covered calls. No,
No,
that's
no
impossible.
covered calls. You can't do any of
Covered
that.
calls.
Just pure cash flow. But
Performance
dividends
plus
count.
dividend. Performance plus dividend.
Performance plus dividends.
2 years.
1,100 shares of Apple or whatever the prorated is, might be 1,120. Whatever prorated Pfizer is to Apple 2 years from now. Are you writing this down, Tim? We
I
need to have
am.
a log of our bets.
Pick
Hold
whatever
on.
time frame. You want to go a year, you want to go to a week, you want to go 2
Well,
years, you
2
want to go
years.
10, you want to go 50 or 100 years. You pick the time frame. I could
2
care
years.
less. And quite frankly, I could care if you're right in that time frame because over a 10-year stretch, I promise you, you would rather have Apple than Pfizer.
2
Hold
years.
on. I got to set a Google Calendar reminder for June 25th, 2022. So that's the only way I would know to remember this. It'll come up in my Google
That's
Calendar.
Apple in the last 10 years. That's Apple. It's had 4 stretches in that time frame where Apple got, cut up pretty good by 30, 40%. Apple has that ability in that. But that is the growth of Apple in the last 10 years. That's the growth of Pfizer in the last 10 years.
Yep. I'm saying I make the bet because every market conditions everything. I'm not saying that Apple over from now to the end of
All right.
time.
Can I get in on this bet and I'll take Beyond Meat?
No.
Wait, you seriously give me 500 shares of
That's
Pfizer
Tim
versus-
turning in a 3-day trade into an investment, by the way.
Hey, how about I take any stock and you take Beyond Meat? That's not bankrupt already.
No.
All right, let's throw it out. Let's throw it out to the team. Which one you getting on? Whatever time frame. Long-term investment. Pick your time frame. Could
That's
care
2
less.
years.
That's an arbitrary time frame.
No,
Pick
well,
your
that's
time
the
frame.
bet. Are we making a bet for
Pfizer,
2 years?
Pfizer or Apple.
No. Oh, I guarantee more people say Apple. No. Apple, sexy.
Yeah, dude,
I'm
I
just
don't
saying
think
when
it's
there's a
close.
25 market correction.
I honestly don't even think this is debatable, quite frankly. And to have the tiebreaker be a 10 P ratio versus a 22 P ratio, I mean, just
But here's the thing: as a contrarian, more people saying Apple just going to solidify Mark's conviction in his Pfizer play.
Listen, if
I
you buy
know.
Apple now and you think it's a good investment now, you are saying that this is going to be a bullish market for 2 years. Plain and simple. It's going to be a bullish market for 2 years. You know, so
we went through the worst economic data we've ever seen, and Apple performed and Pfizer didn't.
You got Jonathan on your side here, Mark. There's not many people on Team Pfizer right now, but Jonathan's there. And
Jonathan's just coming in being like, oh man, I got to get Mark some love here.
dude, I've got it on the calendar. We'll revisit it here in a couple of years. We'll have
I
this
guess you guys,
conversation
I mean,
more later.
seriously, like you're betting on a bull market if you buy Apple at these prices.
I don't
You're
have
betting
fun.
on a strong bull market. So
why are you betting on that with Apple?
Because you absolutely, there is no way Apple can accelerate at this rate for a 2-year period without a robust bull
Mark, they don't have
market.
to accelerate. Why do they have to accelerate? Pfizer's going down. It's been performing negatively. It's getting its teeth kicked in right now. Apple has to stagnate in that environment.
No. If both stocks stagnate, Pfizer wins because they produce a ton more income than Apple does through dividends. If both stocks don't move in 2 years and are at the same price level, Pfizer blows it away from a performance standpoint. So
Bet is on. I've got it marked. By the way, I wouldn't blindly invest in either of these for 2 years. I don't have any fundamental conviction in the market. If I'm choosing one, I would pick Apple. I'm a momentum and a growth trader, Mark. You know me, and you knew I would pick that because it comes down
Timmy
to the
wouldn't
way
invest
your
in Pfizer
personality.
if it was $20 and had a 13% dividend. And
It's not my kind of stock.
Warren Buffett personally showed up at his house and recommended it. Timmy still wouldn't do it.
I would welcome Uncle Warren in. We'd have a nice iced tea, Arnold Palmer on the porch. We would talk about, all kinds of things. I don't think I would buy Pfizer if he told me to, though. No, I might do it just to do it for the story, but no, not necessarily. I enjoyed that conversation, guys, but we got to move on. We're going to actually move into our last thing and just kind of get final thoughts from everybody. We have other companies in the news. There's a couple of earnings stocks that really didn't grab my attention, quite frankly.
Chuck E. Cheese is filing Chapter 11. Mark.
I was gonna.
I know.
They do have a public symbol, but it's not listed anymore. I think they do.
CEC is their public symbol, but yeah.
By the way, Chuck E. Cheese also owns the other pizza shop that's like that. What was it called?
Peter Piper Pizza. Also in the bankruptcy.
Dude, I remember when I was a kid, going to Chuck E. Cheese was the coolest thing ever. I would not go to a Chuck E. Cheese today. There's no chance. Forget COVID-19. I didn't go before. I mean, the pizza's not great. Those ball pits have to be a disease pool now that you think about it when you're going into public. I can see why they
I'm just wondering if I could buy like those mechanical bears that they had. The
ones up on stage.
Yeah. I would like to go buy those animatronic things they have.
Dude,
I'm sure I can get them cheap.
They're creepy. That's like the Disney rides that have those in them too. They just creep me out. There's no doubt about it. Let's bounce around the room. Final thoughts from everybody. Noah, actually, let's bring you in here first. What are you going to be paying attention to? What's on your mind? Final thoughts.
Well, I've had my eye on Okta. You talked about that one this morning. Hope I'm not stealing your thunder, but I love.
Oh man, I like that chart.
OKTA. This is a good looking setup for the bulls. And on my bear list, I've had Momo, which has been from one of our watch lists. Actually for the last 2 weeks, it actually is broken down. So those are two that I've been keeping an eye on and watching. Outside of that, I'm kind of loving the neutrality on some of the charts I'm seeing for credit spreads. So there's a lot of stuff out there that's chopping sideways like the S&P.
You've been doing theta research the entire time, haven't you? You've been looking for credits.
Well, I'm always looking for theta. And one of the things I do is I convert directional trades. I add positive theta to them. If I can get one to go positive, I'll sell stuff against it to bring in some theta once I'm operating from a point of profit.
Yep. All right, I'll go next here, guys. And by the way, if you're out watching our show for the very first time, we got a lot of new people here. Welcome out. Come back and join us every day. We have a lot of fun doing this. And if you are a veteran, appreciate you guys. #Team Tackle. This is my favorite section each and every day, the Coach's Corner. So some stuff I'm watching here, Matt Olli, OLLI, picked it up in his screener here today. One of these discount companies, kind of like, the dollar store types and whatnot, a little pullback, retracement into those moving averages. I do like that setup a little bit here. You had mentioned Okta. Noah, I do like that one as well. Wayfair, frequent on many watch lists. Little W breakout, hit up there into a new high at 221, coming back into the rising 9 EMA. There's your girlfriend right there, Marquis. As always, those MAs tend to come into play once you learn how to read them. You had mentioned the Octa. I'm also watching on the bear side this CME. Cody, I'll bring you in here next. You can talk about those too. If you miss the breakdown, sometimes what happens, and this is a good lesson in intraday charting and something that traders do, when you're learning the step system, for example, if you miss that initial surge, sometimes you'll get these little pullbacks back into the old resistance point that can set up a new setup. So I know it broke down and sharply sold off yesterday. And now it's coming back a little bit here into a doji somewhere in that 170 to 172 range, or even if it just started selling from here, there's a lot of setups where you could still make a trade and map out a good bear trade if you're looking for something on that side of it. Cody, next, young man, you had a couple. You just popped in the chat and said, hey, I want to talk about these two. So come on in here, young man.
I got two, and then I got a little one in my arm. So if he screams, I apologize. I like CRM, old Salesforce.com. I like that little pullback we got right to the 9-period moving average. Quick little simple entry there with very easy controlled risk.
Yeah, that's a nice draw. Whoever drew that line, I don't know who did it. The old resistance become new support, rising moving average. That's a good catch.
Absolutely. And Lily, LLY. I like that. Quick
breakout.
Easy. Yeah.
Breakout up there.
It had that pop up. It had a little pennant or flag, whichever you want to call it, down to that initial breakout zone. Today, nice easy pop up. Triggers would be probably above today's high.
Very cool. Marky, you're next. What's on your mind? What are you looking at?
I'm not doing a whole lot. I got a lot of naked puts out there on a lot of different stuff, spread out through a lot of different industry, expiring tomorrow, the next week, that week. So I don't want to overextend myself where I am margin wise. So I'm standing pat today.
And especially with that bank stress test, are you just kind of waiting on that as well?
Well, plus, no, yesterday, like with that, like big bump in volatility you have yesterday, anyone who does a lot of naked puts, those are the days that are really active. And then when it mellows out,
sure,
they chill out as well.
Yeah. You're chilling on a doji day here. Maddie, your last words here, final thoughts.
Just be here tomorrow. Obviously, we have a major announcement later on tonight with the Fed announcing their first take at the stress test of the banks. Now, remember, they are testing 3 different economic outcomes here: V-shaped, W-shaped, U-shaped economic recoveries, and how the banks perform in those economic models, and are they still solvent? Right? That's the ultimate question. I think we're going to get a lot of nonsense out of the Fed tonight. There's already indications that they are not going to be transparent in if certain banks fail the stress test. That's an indication that they expect certain banks to fail the W or the U-shaped economic recovery stress test. So you're going to have a little bit of interpretation of the Fed talk to really understand where the Fed sees the ultimate risk in the banks. And so I'll be watching that like a hawk later on tonight. And then obviously I'll have a few things to say about the stress test results tomorrow.
Yep. Love it. And as always, last thought here, guys, if you are new to our community, you like what we do, you want to learn from the coaches here at Tackle Trading, get over to the website, tackletrading.com, click the link I just dropped in the chat, or there is a link in every description we put on YouTube where you can sign up for your trial. Start your trial right there, 15 days on us. Most of what we do here at Tackle Trading, education, community is a big part of it as well. And when we're talking about education, get in there, use the courses, use the webinars, use the lounges like Mark talked about earlier, use tonight's webinars with the Cash Flow Club with Coach Tyler, the blogs for the pro member content. There's a lot there, 14, 15 hours of live webinars a week, I believe, as well as courses and a lot of content. And it's a real simple offer, Matt. It's 15 days on us to try it out. See if it's for you, see if our community is for you. We believe it will be. We're very confident in what we do. So come out there and join us. And if you're a pro member out there, appreciate you. Just in the chat, give me a blast. Pro member, type it in the chat, pro member, and let's represent Team Tackle. All right, guys.
Very quickly, Tim, Chris, great point. Erickson, 5G play here. Coach Gino, who is our 5G expert at Tackle Trading. he's obviously got to be happy today. News out of Singapore, Ericsson and Nokia, both 5G plays, both of them had really good price appreciation on that news. So Chris, great catch on that.
Love it. And Gino was talking about 5G. He has like these 150 list long 5G watch list he's been tracking. It's one of the things he is all in right now on. There's no doubt about it. He's been tracking it. He's been studying it. He did that webinar about 6 weeks ago on the 5G watch list, Matt. And yeah, definitely good catch on those things. Guys, that's it for today. Any good site for options training for free? Painkiller, that link I just dropped, go sign up and you go watch the options 101 report. You know, you got 15 days to go through it and whatnot. That'd be a great place for you to start. All right, guys, we're out. We'll be back tomorrow, same time, same station. We'll have Frank here for Friday like he always is. We'll see you then, guys.